Mic testing, mic testing. Hi guys, how are you doing? Yes, so let's begin. So today we will be doing an interesting area of buyback and ESOP taxation. Okay, these are very interesting areas, both buyback and ESOP taxation. So let's get on with it. All right, guys. So buyback, come to page 02. If you remember, the previous time we had done liquidation when we did 46.1, 46.2. And then we'll say we'll come back to this later, I told you. Now we are coming back. Please come to 02. Right? And yeah, all this intercorporate dividend, all that we previous class we finished, guys. Buyback 02. Guys, buyback of shares is governed by Section 68 of Companies Act. Right? Section 68 of Companies Act. So before we go into the tax part of it, let's see, how a company can buy back, what it can do. Many companies have bought back, Infosys, Wipro, TCS, regularly they do buy back shares. Why do they buy back shares? Basically, if they have adequate funds and they have already given dividend, and also the fact that they have invested everywhere and still they have excess funds. So of course they are going to buy back the shares in such a manner that, people will obviously feel that the company is doing so well that even after, so much money also they have the funds with them. So that's how it works. That's why they're buying back the shares. So obviously eventually what will happen is the share prices will go up. So guys, in Companies Act, Section 68 talks about it. In the previous class only we discussed, notwithstanding anything contained in this act, which means what? This section overrides all the other sections. So I told you this section overrides the reduction of capital section also, right? So if you buy back shares, ideally it will be reduction of capital, no? Like for example, I have 1 lakh shares. I bought back 20%. So now it is 80,000 shares. Isn't it reduction of capital? Yes. But Section 68 says it will not amount to reduction of capital. But subject to the provisions of subsection 2, that so company may purchase its own shares. Shares here means what? Equity and preference. But it is not preference, because for preference shares, another section is there, 55.2 in Companies Act. 55.2 is redemption of preference shares. So this predominantly is what? Equity shares. Since there is a specific section for preference shares, 55.2 in Companies Act, for equity shares it will be section 68 or other specified securities. From where can I take out? I can take out from free reserves, I can take out from security premium account, or proceeds of issue of any shares or other specified securities. So guys, if I have free reserves with me, free reserves, I can take it out from there, or I can take it out from securities premium account. Securities premium account is like a quasi capital. So if a share is valued at 100 at the premium of 80, 20 rupees is, let's say, the face value, and 80 rupees is the premium. So basically it's like you're paying something extra for the shares. That is called as securities premium account, as you know. So I can take it out from my free reserves or from securities premium account, or the proceeds of any of the issue of any shares or other specified securities. I can make a fresh issue of shares, is what they say. Provided that no buyback will be made out of proceeds and early that you leave. So the buyback should be authorized by the Articles of Association. You should pass a special resolution at a general meeting. So before that, of course, since you're buying back shares, you should also pass a board resolution. Then it should be mentioned in the Articles of Association that buyback power is given. Then you should pass a special resolution. Special resolution means 75% majority. Then all those things, 25% of the aggregate capital should be maximum. Ratio of the secured and unsecured debts after buyback should be, maximum 2. This talks about the debt equity ratio. Debt equity ratio must be maximum 2. Then all other shares should be fully paid up. Buyback of shares or other specified securities listed on a recognized stock exchange in accordance with the SEBI regulations. And the buyback in respect of shares or other specified securities other than those specified, all those things must be given. That other things you leave, that's what it is. Now, where can I buy back from? I can buy back from existing shareholders or security holders on a proportionate basis. I can buy from the open market, from the stock market. And we've always been telling, stock market, off the market, stock market. Off market transactions means without the market being there. Then by purchasing the securities issued to employees of the company pursuant to a scheme of stock option or sweat equity. So those people who have already got ESOP, stock option or sweat equity, I can buy back from them also. So in this session, we'll be doing both ESOP taxation when you give stock option and when you buy back also. Can you buy back from the same guys to whom you have given ESOP? Yes. Or can you buy back from other people also? Yes. That's what this section says. That's all is there to it. Now, for our income tax purposes, there are two sections. One is 46 capital A. Other one is 115 QA. 46 capital A is one, then 115 QA is the other one. So if you see guys, 46 capital A. Capital gains on purchase by company of its own shares or other specified securities. The same wordings that you saw in section 68 of Companies Act. That's why I take you to Companies Act also, because it becomes easy for you to understand. Where a shareholder or a holder of other specified securities receives any consideration from any company for purchase of its own shares or other specified securities held by such shareholder or holder of other specified securities, then subject to 48, the difference between the cost of acquisition and the value of consideration received by the shareholder or the holder of other specified securities shall be deemed to be the capital gains. So the cost of acquisition and the value of consideration received by the shareholder. So whatever the cost of those shares minus the actual value that is received by the shareholder will be the capital gain. Now guys, this was section 46A. If you see specified securities, if you see, it is similar to section 68 of Companies Act. That's what we had seen now. This will be as per the MCA, whatever they prescribed. So guys, earlier, no, this section was there for listed companies. And for unlisted companies, we had 115 QA. See, tax on distributed income for in case of domestic company. Notwithstanding anything contained in any other provisions of the Act, in addition to income tax chargeable in respect of total income of a domestic company, any amount of distributed income by the company on buyback of shares. Now you see here, not being shares listed on a recognized stock exchange was there. So 46A was for listed companies. 115 QA was for unlisted companies. That has been removed when? From Finance Act 2019. Which means from Finance Act 2019, 115 QA also will be there. 46A also will be there. To ensure what will apply, they have made it very clear in the proviso. Provisions of this subsection shall not apply to such buyback of shares, being shares listed in respect of which public announcement has been made on or before 15th July 2019. So guys, even though section 46A has not been deleted, it is still there. But because of this insertion in 115 QA, because of this proviso, section 46A has lost its significance. Yes or no? Yes. That's why if you remember there, I didn't even do it. I just read it. I didn't even actually teach. I just read what is there. Because as of today, though the section has not been deleted, because of another proviso in some random section 115 QA, what has happened to section 46A? It has become redundant. There are many such sections in Income Tax Act where because of this section that has been redundant, that has become redundant. So that's what we need to understand. Right. Let's see. Same if you see, many means purchase of a company by buyback of its own shares with the provisions of any law for the time being in force related to companies, which means Companies Act only, section 68. So if the share issue price is, let's say, 1000 rupees and the company had initially issued it at 300 rupees, so what would be the tax? Tax will be on 700 rupees. Very simple. That's how it works in 115 QA. There is a fixed percentage, 20% plus surcharge, etc. That is the percentage that is given. That's it, very simple. And this income would be exempt in the hands of the shareholder. Because the company is paying tax, at the hands of the shareholder it will be exempt. Now, is this deemed dividend? Tell me, is this deemed dividend? No. In the deemed dividend section, we had clearly seen in the exclusion that buyback. Remember guys, deemed dividend. Sir, when you did deemed dividend, sir? I don't remember only. Hey, nonsense fellows, we are done guys. Come on. Section 222. In that 222, dividend includes ABCDE. Then dividend does not include ABCDE. In that ABCDE, this thing was there. Swami Nityananda Swaha. It's not working. Swami Nityananda also is not able to do anything with this today. Okay. The sun was sleeping. Just like that internet was sleeping because Swami girl was walking. That fellow I told in one of those videos. Today I came 5 minutes late. That's why the sun also came 40 minutes late. Like that one dialogue you had put. Yes. Dividend includes ABCD. Then dividend does not include. There. Any payment made by a company on purchase of its own shares in accordance with this. So basically this is not deemed dividend. So the gist of the story is, my dear friends, gist of the story is what? Buyback. Company will pay tax. Company will pay tax. Very, very simple. At what rate? 20% on distributed income. 20% of distributed income. Plus 12% surcharge. Plus 4% health and education cess. So overall comes up to 23.296%. It is fixed. Company will pay tax undoubtedly. Next, what will happen? Exempt in shareholders' hands 1034 capital A. Distributed income is same, that is given there. Generally the buyback price minus issue price. And not deemed dividend. It is clearly given in the exclusion. It is not deemed dividend. That's the gist of the story, guys. Check it out. So this is 46A, 115QA, both for listed and unlisted. And listed is from 2019. So amount received by the company in respect of issue of share, the share issue price, etc. will be determined as per Rule 40BB. So the most important thing in this particular thing is nothing but Rule 40BB. How it works and all we should see. That's it. Come back, guys. Come to this page, page number 0.2. Where a company purchases its own shares or other specified securities, the difference between the cost of acquisition and the value of consideration. Yes, so we have seen here 23.296%. You should remember this part. as referred to in section 115 QA, and then shareholders 1034A. PJ Limited issued 10,000 shares at 110, face value 50 on 14/7/2017. On 25/6/2022, PJ Limited decides to buy back 5,000 of its shares at 500 rupees per share. In this case, how much will it be? 5,000 shares I'm buying. 500 minus 110 issue price into 23.296%. So 4,54,272 capital gain will arise. Shareholders will be exempt from tax in case of a buyback. If the listed shares obviously are held for more than 12 months, then the benefit of indexation is available. In this case, I have not considered it, but yes, benefit of indexation is available. Specified securities include employee stock option also, another securities notified by CG. The company is required to pay tax to the government within 14 days from buyback. Very simple. As per section 115 QB, if the tax is not paid within 14 days, then the company will be required to pay an interest at the rate of 1% per month or part thereof for the expiry of 14 days. As per 115 QC, the company fails to pay the tax, company will be treated as SSE in default, and all the provisions of SSE in default which we had seen will come to this particular case. Very, very simple. Now, this is the thing. 40 BB, determination of issue price. Scenarios under which issue price can be determined for the purpose of buyback. So this is important. They can ask you an MCQ and all those things. How will you determine, etc. This can come. First, share issued by a company by way of subscription. So issue price shall be the amount received by the company including securities premium account. So ABC Limited issued shares of face value at 10 at a premium of 80. In this case, what will be the issue price? Obviously, it will be 90 rupees. Including premium, I should do it. So basically, today buyback price was 300. So what will this be? 300 minus 90. Very, very simple. 300 minus 90. And one thing to understand here is, guys, this surcharge, etc. has to be paid even if the company's total income is nil. So I told you, surcharge 12% and 4%. You can write down here only. I'll write here actually. This one. This has to be paid. It is mandatory. It does not depend on total income. Doesn't depend on total income. So if this company has taken some, ATIA deductions and all, it has gone to Northeast and built one hotel, all this, the total income is nil, then and now it's buying back shares, then will surcharge not apply? 100% it will apply. So instead of this, you can just remember 23.296%. Please remember the rate, 23.296%. So come to this. This is sub rule 1. Rule 40 VB 1. I'll write here 1 so that example will be for 1. So for instance, PQRS. For instance, let's take PQRS. P. So the company issued these shares, 10 lakh shares at 10 each. For Q, 10 lakh shares at again 10 each. 10 lakh shares at 10 each. Premium of 20 each. 10 lakh shares at 10 each. Premium of 20 each. Company is buying back how much? 1 lakh shares each at 50 rupees per share. So what will be 115 QA? PQRS. 1 lakh into 50 minus 10 here. 1 lakh into 50 minus 10. 1 lakh into 50 minus 20 plus 10, 30. 1 lakh into 50 minus 30. So it is 40 lakh, 40 lakh, 50 minus 30, 20, 20 lakh, 20 lakh. Overall 1.2 crore. This 1.2 crore into that percentage, 23.296%. Tomorrow, if this is before this buyback, if company reduced 10 rupee share to, let's say, 8 rupees and 5 was bought back, then what should I do? If they reduce the capital, it's possible, no? Face value of 10 each has now become face value of 8 each. Correct? They have reduced the capital. Reduction of capital has happened. Very much possible. Then they have made it 5 rupees was bought back. Then what to do? Will it become here 50 minus 5, 50 minus 5, 50 minus 25, 50 minus 25? Will it become like that? We'll see. We'll see this. So guys, check that next rule, you'll understand. Issue price, see this, sum out of amount received returned by the company prior to buyback. There is a reduction of capital. Then issue price shall be reduced by the amount returned by the company. In the above example, if the company returned 10 rupees prior to buyback, issue price will be 90 minus 10, 80. If the company has paid additional income tax under 1150 on returned amount, then it shall not be reduced. This, I'll give you a better example than this. Same, all these things. 8 rupees it has become, and then 5 rupees we have given. Now, it all depends on one thing, as you know. If reduction of capital has happened, fair enough. What is the distribution that has happened? What is the distribution? Value of shares, they have reduced from 10 rupees to 5 rupees. So what is the distribution? 5 rupees has been distributed. 5 rupees has been distributed into what would be the shares? 4 lakh, correct? 4 lakh. The shares are actually, one second. Sorry guys, 40 lakh I told you, no? 40 lakh. 1, 2, 3, 4. What I am saying is 40 lakh shares were there, 5 rupees cash has been paid. 2 CR. 2 CR. Now I need to see. I have already distributed to shareholders. If reserves and surplus of the company is greater than or equal to 2 crore, then what happens, guys? This will become deemed dividend. If you remember, deemed dividend is always to the extent of the reserves and surplus. So if the company has reserves and surplus greater than or equal to 2 crore, then this entire 2 crore will be deemed dividend under 222D, taxable in the hands of the company. Sorry, in the hands of the shareholder. That is done. And here, capital gain for company would be what? There would be no change. There would be no change. It will be the same. Because the person has already paid the tax, because shareholder has already paid the tax, here I will not subtract that amount. Think about it. If I subtract here, then this will increase. If this will increase, it will result in double taxation. That is not, preferred. So, if taxable in the hands of the shareholder, CG for the company will be same as discussed. I'll put 1 star. Which star here? This star. Same. No change. But if reserves and surplus are, let's say, nil, if reserves and surplus are nil, then there is no deemed dividend, no tax for shareholder, capital gain for company. So guys, tax has not been collected from shareholder. So don't you think so? These people should pay more tax. Which company should pay more tax? Yes. How will the computation look? It is not taxed only. What is not taxed? Deemed dividend is not taxed. So for PQRS, for P, it will be what? 1 lakh shares, 1 lakh shares, 1 lakh shares, 1 lakh shares into. Initially, a buyback price is 50, but now I will not take it as 10 rupees, I will take it as 5 rupees. Because here I am reducing, the difference will become more. The difference will become more, tax will become more, obviously. So this will become, instead of 40 lakhs, 45 lakhs. Same. This is what? 50 minus, instead of 30, 50 minus 25 it will be. This will become 25 lakh. And this also will become 25 lakh. Overall, how much, guys? 1.4 crore. See? $1.2 crore has increased to 1.4 crore. On this, there will be tax. 23.296%. So the reduction will happen when? When will the reduction happen? What is the thumb rule? If prior to buyback, company had given money to shareholders and it was charged to shareholder as deemed dividend under 222A, B, C, D, E. Then in 115 QA, do not reduce issue price. Do not reduce issue price. But if it was not charged to tax. That is no deemed dividend. Under 115 QA, need to reduce issue price. This would be the thumb rule. This would be the thumb rule. Very, very simple. Okay, come on, fist pump, come on, guys. Did you understand? Thumbs up, all of you. Great. Easy, easy, easy. Don't do heavy duty stuff. Yeah. Shares issued under ESOP or sweat equity scheme. So issue price shall be the FMV of the issued or amount credited to the share capital including security premium account, whichever is less. So ABC Limited issued sweat equity share of face value 10 at a premium of 80. FMV of such shares on the date of issue was 100. In this case, issue price shall be FMV of the shares 100 or the amount of share capital including security premium 90, whichever is less. So therefore it is 90. So I would have issued whichever is less, I should take FMV or the other one. So in ESOP, what happens? Though we will be doing ESOP taxation next, but just for the thing, ESOP. So obviously it's a stock option plan. So initially they will ask you to, they would give you the option that if you work for 2 more years, then you will be eligible for the shares. And then you can choose either to buy or not to buy at that predetermined rate. If you choose to buy, finally we will allot the shares. So this eligibility, this waiting for 2 years is called vesting period. Eligibility is on the date of vesting and then allotting. FMB will be here also at the date of the option. FMB of the shares, let's say, is 1000 rupees. Here it becomes 1200 rupees. The day of allotment is 1400 rupees. What should I take is the question. So you see, so that will be as per rule 3.8, which we will discuss in ESOP taxation, that you leave. But here coming to that, we are now not talking about taxation of ESOP for them. We are talking about for the company. Let's discuss that. So if an Infosys employee gets an employee stock option plan, let's say he gets it at nil, free he will get, or he will pay, let's say, 100 rupees. The FMB as computed under rule 3, which we will see later. Today only we will see, this class only. 2000. Here also it is 2000. What would be the perquisite? So guys, this will be in the hands of the employee, a perquisite. So here it would be obviously 2000 will be perquisite. Here it is 2000 minus 100, 1900 would be perquisite. So I'll say ESOP slash sweat equity. Because this, when I say nil, this is the sweat equity. Generally, it is for consideration other than cash. So this will be taxed as a perquisite in the hands of the employee. We are not even talking about that. We are talking about what? We are talking about what if these shares are bought back. What if these shares are bought back? What will be the tax on the company? I showed you section 68. That's why I showed you. The buyback can happen from the open market, or it can happen from those where I've already given as ESOP and sweat equity. That's why I showed you, right? So now let us discuss from the company's point of view. Okay, don't get confused. This is what ESOP taxation. This will be handled in ESOP taxation immediately after this session. In this session only, immediately after discussing this concept. Which concept? We are doing rule 40BB, right? Now, let us talk about if the company now buys back this ESOP. Like for example, this fellow or sweat equity, this fellow has got 2000 rupees, this guy at 1900. Let's say they pay 4000 rupees. What would be the, what do you say? Tax is the question. So that's what the difference that FMB, or if you see the FMB or the, here you see share capital including securities premium, whichever is less. Anyway, give an example because little bit a split also has to be made. Check it out. See there, those examples are for one day before the exam. That's why I've given in the book. Everything we can't put in the book, guys, because that book has been designed solely for, 1.5 days before the exam. But everything else will be done in class, as you've been seeing, which will actually give meaning to that book in a much, much larger way, right? So let's say, suppose a company issued ESOP or sweat equity. 10,000 shares to Mr. A at rupees 100 per share, being the face value. Fair market value as on date of exercise of option is 1000 rupees. So what is the perquisite, as I told you, in the hands of the employee? 1000 minus 100. Already discussed the same stuff. 900. 900 into 10,000 shares. 90 lakh rupees. Fair enough. Now, the company, little bit of accounting also will come. Company can pass the entries in two ways. Case number 1, case number 2, accounting entry. One, ESOP expenditure debtor, 90 lakh because this is expenditure. Bank account, 10 lakh because I'm getting this, 10 lakh. 2, share capital account, 10 lakh. 2, share premium account, 90 lakh. The other case, direct bank account, 10 lakh. 2, share capital account, 10 lakh. Direct. Here, I'll write company wants to buy back price 1300. So in this case, guys, it will become what? Share capital and securities premium, both it will be. So distributed income will be what? 1300 into 10,000 shares minus 1 crore. 1.3 crore minus 1 crore, 30 lakh. So 115 QA will be on 30 lakh. On the other hand, here distributed income will be what? 1300 into 10k minus 10 lakh. So company will pay what? 115 QA on 1.2 crore. So it should be on what, guys? On FMV? It is 1000 or 100, whichever is less. So ideally speaking, this is correct. This would be wrong because, first of all, this is what they do for tax planning. Because it's a share capital or security premium account for tax planning, all this golmaal they used to, they kept doing. Come to this, I'll show you. See, the amount credited to the share capital and share premium account by the company shall be deemed to be the amount received. Shall be deemed to be the amount received. So what the companies used to do now? They used to claim this also as an expense and pay this also at a lesser rate. What they have done now in certain rules, and also this particular thing has been disallowed. Income Tax Act. When you come to ESOP taxation, we will see. The moment that is disallowed, there is no point in adding this entry. It's not an expense, first of all. So if you disallow, they will never pass any of these entries like this. So they will pass this entry only. So what will become easier? This one. 1115 QA on 1.2 crore. That's the reason why I have written whichever is less actually, because this tax planning left side should not happen. That is wrong tax planning. Got it, guys? Very simple. Next. Shares issued in the scheme of amalgamation in lieu of the shares of the amalgamating company. Very simple. One company is, you will getting shares in the other company. What would be the same? Maple Limited amalgamated with Thunder Limited. Thunder Limited issued 2 lakh shares to the shareholders of Maple Limited. Maple Limited had issued 50,000 shares of 28 each amounting to 14 lakh. Issue price shall be 7 rupees per share. How? 14 lakh divided by 2 lakh. Because earlier, guys, I had 14 lakh. Now I am getting what? 2 lakh shares. So what would be the share? 7 rupees per share. Simple math. So let's take one more example. Mr. P acquired 10,000 shares of PJ Limited at 20 per share. PJ Limited got amalgamated with KG Limited, and Mr. P is allotted 30k shares at 10 each in KG Limited. KG Limited now buys back 5,000 shares at 15 each. Very simple. So guys, how much did Mr. P invest 10,000 shares into 20? Basically, he had invested 2 lakh. That's all there is to it. How much is he getting from KG Limited? 30,000 shares is getting. So what would be the actual, value for Mr. P in KG Limited? It would be 6.67 per share. 6.67 per share. Very simple. Now you see. Distributed income, same stuff. 5,000 is buying back at 15 each. Minus what is the issue price? 5,000 shares into 6.7. That's all. This will be the distributed income. Distributed income definition is the same only. Buyback price minus whatever is given. That's the same. That is not changing. Everything else is changing. Simple. Same logic for demerged company. But in demerged company, what do you say? This will come. Shares issued by the resulting company in the scheme of demerger. Amount received by the demerged company for the issue of share into net book value of assets transferred in demerger, net worth of the demerged company before such demerger. For the demerged company, amount received by the demerged company for the issue of shares minus amount determined for the resulting company. See here, you'll understand this. ABCD Limited issued 1000 shares of 600, face value 100. During previous year 2023, D Limited was a resultant company formed after demerger of ABC Limited, now the demerged company. D Limited issued 500 shares to the shareholders of ABC Limited. Total assets transferred during demerger were 100 crore. The net worth of the demerged company prior to demerger was 400 crore. In this case, issue price for the resultant company shall be what? 1000 shares into 600. What was there before? Into what? How much of the net book value was transferred in demerger? 100. Correct? 100 crore. Out of 400 crore was transferred. This was the overall share value. This was the basically 1/4 of the company is transferred. So what would be the issue price of the resultant company? Obviously, overall value of the company into what part of value that was transferred. That is this much. So now issue price per share will be what? It purely depends on how much shares were issued. 500 shares were issued in the demerger. So 1,50,000 by 500, 300 rupees per share would be the basic issue price. What is the issue price for the demerged company? Overall 6 lakh was there, in which resulting company took over 1,50,000. So the demerged company 4,50,000 is allowed. And what is the issue price for the demerged company per share? Same, 4,50,000 by what is the shares which were there before? 1,000. So it is 450 per share. Very, very simple. Value of the resulting company is 1, value of this company is 1. So wherever I am receiving, that person should do the same thing. This we will also discuss when we do demerger. Separate chapter is there. You will understand there this calculation again. So it's very simple. So if you see, share issued by the resulting company in the scheme of demerger, for the resulting company is what? For the demerged company is what? In this, the resulting company is D Limited and the demerged company is ABC Limited. So first I have to compute issue price of the resultant company. Overall shares 1000 into 400, 600, sorry, the market value. In that, how much part is demerged? 1/4. 100 by 400, 1/4. So 1,50,000 is demerged. That is the resultant company. What is left in ABC? What is left in ABC? Obviously, overall value 6 lakh minus the demerged portion 1,50,000. So 4,50,000 is left. So what is the issue price for the demerged company? 4,50,000 by 1,000. What about issue price for resulting company? 1,50,000 by 500. Very, very simple. Very, very simple. Bonus shares issue price will be nil. Guys, this has become fully redundant actually. Point number 6 not needed, redundant. 7 redundant, useless it is. 8 done. 9 redundant. 10 will do. Shares are brought back which were held in dematerialized form and the same cannot be distinctly identified. We have discussed it should be based on FIFO. ABC Limited issued 100 shares at 50 on 10/4/22, 200 shares at 55 on 15/4/22 and 300 shares at 60 on 24/22. ABC Limited decides to buy back 500 shares. In this, issue price per share will be determined by FIFO method. How? In this 500 shares, first one I will buy. How much? 100 at 50. Next, 200 at 55. Then I need only 200 now. 200 out of 300. So 200 into 60. Issue price shall be the face value of the shares. Alright guys, please come to D18. Please come to D18, income from units. It's a very small thing, we'll finish it off, income from units. Very easy. So similar to dividend, any income received in respect of. So what used to happen was, one second. Income from units. So prior to 2020, income earned by mutual funds or income earned by unit holders. Income earned by mutual fund was taxable at the rates under 115R, whereas by unit holders were exempt under 1035. So income earned by these mutual fund houses, etc., is taxable for them under 115R. So after 2020, Finance Act 2020 brought about this change. They said, now let us change the entire deal and let us make it chargeable to whom? To the shareholders, the unit holders. So after that, after 2020, units, that is the income earned by mutual fund houses is now exempt under 1023D, new section. Just like dividend, guys, is also changed. Then by unit holders, it was taxable at applicable rates. Taxable at applicable rates. Unit Trust of India, UTI, after the Ketan Parekh scam. Ketan Parekh, he was a, what do you say, protege. Protege means is, what do you say, Shishya. Shishya of whom? Harshad Mehta. Ketan Parekh scam in 2002. So this Unit Trust of India lost lot of money, guys. So Unit Trust of India Transfer of Undertaking and Repeal Act was formed in 2002. Unit Trust of India Transfer of Undertaking and Repeal. So UTI was repealed and this law came into force. And UTI became two parts. One was a specified company One more was administrative company, administration. UTI administration had all the children's scheme. All the children's scheme went to that. All the children's scheme went to that. Now, how much income, what do you say? How much expenses can I claim? And all these income from units, etc. for unit holder. After this one. This will be taxed where? Under IFOS. That is why this chapter here, IFOSC. Mutual fund, specified company means what? UTI. Then administrator, UTI. Shall be chargeable in the hands of the unit holder under the head other sources. Deduction in respect of dividend or income from units. From the amount of dividend income from mutual fund, no deduction for any expenses shall be allowed except for interest expense. Such reduction for interest expense shall not exceed 20% of the amount of dividend income from the mutual fund. Mr. A received dividend from ABC amounting to 20 lakhs on 28/3/2020. He has borrowed sum of 1 crore. So now we'll come to that. You have borrowed money for that. So will you get interest? So guys, all that is given in section 57, right? So expenses. Investment of units of, one is mutual funds, one is specified company. One more is what? Administration. So what expenses are allowed under section 57? For mutual funds, 20% of, you have hired some person to write the, you are giving salary to him, he will handle all your investments. Will that be covered? So I'll make it into two things. Interest expense, other expense. Interest expense, other expense. Similarly, administration, interest expense, other expense. How much will the interest expense be? How much is allowed? Is other expense allowed? I've already shown you. Let's see again. Section 57. Here you go. Section 57. In that, all these things, dividend, interest on securities, family pension, other expenditure, all this there you see, proviso. No deduction shall be allowed from the dividend income or income on respect of units of mutual fund 2023D or income from units of specified company 1035 other than deduction on account of interest expense. And in any previous year, such deduction shall not exceed 20% of the dividend income or income in respect of such units. So guys, income of, here also I'll write down, specified plus admin. It is exempt under 1035. Unit holders, definitely taxable. Now tell me guys, interest expense, how much? 20% of that interest income, 20% of income. So if I earn 1 lakh, 80,000 I should offer to tax, 20,000 is allowable deduction. Other expense not allowed. Interest expense 20% of income. Other expense not allowed. Oops, sorry. So they'll ask in the exam one question. They can ask units of administration, income earned is 1 lakh. Interest payable is 30,000. Other expenses are 20,000. How much is allowed? Option A, 30,000. Option B, 50,000, 30 plus 20. Option C, 20,000, 20%. Option D, none of these. Answer. What did I ask? Total income earned is 1 lakh. Interest on the loan that you have taken to earn this amount is from administration unit, from the children's scheme. Interest is how much? 30,000. Other expenses 20,000. They'll ask how much expenses allowed as a reduction under 57. MCQ question. First one 30K. Second one 50K. Third one 20K. Which 20K? Income into 20%. Fourth one, none of these. Answer. 99% of the students will tick 20,000 and come. Answer is 50K, my dear friends. How, sir? What are you telling? Please see. In 57, mutual fund unit is there. Specified company is there. Where is administrative company? Not there. Administrative company is not there. This is there. This is there. Administrative company is not there at all. So guys, good, got it? Fully allowed. Fully allowed. Important. As per proviso to section 57. All this is what? Proviso to section 57 only. Proviso to section 57. As far as taxes are concerned, that would be what? Same, TDS or capital gain as such. As far as TDS is concerned, 194K will come. Income more than 5,000, TDS at the rate of 10%. TDS at the rate of 10%. Capital gain depends if it's an equity oriented fund or it is other. If it is other fund, 112 will come, 20% tax. If it is an equity oriented fund, then we have to see whether it is short term or long term. 111A, 112A. So it would be 15%, here it would be 10%. If what? If it is two things. One, stock exchange where STT is paid. Second one, sold to another mutual fund where STT is paid. If STT is not paid, then normal provisions will come. This you have already seen, guys. I'm just repeating. So two things, stock exchange is there and STT is paid. Second one, sold to another mutual fund and STT is paid. Yes. So these two things will come. That's all there is to it. Nothing else. Chilled out. Same stuff is given here. Easy. Right? Done. Cool. So actually guys, I thought I'll do ESOP in this only. No problem. Next session I'll do ESOP. Okay. ESOP is immediately next session. ESOP and ESOP tax on startup. Both will do next session.